Most people know that you pay Social Security taxes during your working years as part of your FICA tax, but few may know whether or not they're going to be taxed on their Social Security benefits once they start receiving them. The truth is, since 1984, anyone who exceeds the stated income thresholds will have to pay taxes on a portion of their Social Security benefit, and the thresholds have remained unchanged. So, what constitutes income for this test? Well, your adjusted gross income such as wages, self-employment, interest, dividends, and other taxable income that must be reported on your tax return, plus your non-taxable interest, plus 1/2 of your Social Security benefits. Now all of this adds together to make up your combined income. For single filers, if your combined income is less than $25,000, then you actually won't owe any tax on your Social Security benefits. If you're between $25,000 and $34,000, then 50% of your benefit may be taxable. And if your combined income is over $34,000, then 85% of your Social Security benefits may be subject to income tax. For those who are married filing jointly, if your combined income is less than $32,000, then you may not be subject to income tax on your Social Security benefits. If you're between $32,000 and $44,000, then 50% of your benefit may be taxable. And if your combined income is over $44,000, then 85% of your Social Security benefit may be subject to income tax. Let's take a moment to consider the example of Bill and Sue. Bill and Sue are retired and have $90,000 of adjusted gross income. Remember, this also includes any distributions from tax-deductible accounts like traditional IRAs and 401ks. They show nothing coming from non-taxable interest and $32,000 in combined Social Security income. When added together, this totals $122,000, but their combined income for the Social Security taxability test is $106,000, which is the $90,000 of adjusted gross income plus 1/2 of their Social Security benefits, equaling $16,000. Now, remember, they're only taxed at 85% of their benefit, so 85% of $32,000 equals $27,200. Since Bill and Sue are in the 22% tax bracket, their federal income tax on their Social Security benefits would be $5,984 per year. For recipients who are not expecting to pay any taxes on their Social Security benefits, this has the potential to have a drastic impact on their retirement portfolio. If Bill and Sue want to make up the lost income of $5,984, they would need to pull an additional $7,672 from their traditional IRA or 401k accounts, given that they're in the 22% tax bracket, so that they can net the desired $5,984. Ignoring inflationary increases, which would generate additional tax over time, the opportunity cost to their portfolio over a 20-year time frame would be $234,491 at a 4% net rate of return, or $295,398 at a 6% net rate of return. Remember, this is without factoring in income taxes from any of the 13 states that tax Social Security benefits in some way. We're looking at you, Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, North Dakota, Rhode Island, Utah, Vermont, and West Virginia. You know who you are. Clearly, there's a large percentage of the population that may be subject to taxes on their Social Security benefits. It's important to factor those in when planning for retirement. For some, that could include taking advantage of Roth IRAs, Roth conversions, or Roth 401ks, to name a few options. Working with a certified financial planner or other financial professional is another way to help prepare for your future, whether your retirement is still decades away or just around the corner. If you enjoyed this video, be sure to check out our other videos in our Social Security series. And as always, don't forget to like, comment, and subscribe. We'd love to hear your ideas on other topics you'd like to see covered. Thanks for watching.